Welcome to This Explainer. Today we're going to completely flip how you look at a company's success. I want you to imagine a business reporting a profit of 1 lakh rupees. Sounds amazing, right? A big, solid, impressive number. But honestly, without context, raw profit numbers are kinda just an illusion. Until you actually understand the financial ratios operating beneath the surface, you're really only getting half the story. Okay, let's dive into this. Here is our roadmap for today. First, decoding financial profitability, then income statement ratios, followed by return on assets and asset turnover, and finally, the owner's equity returns. Section 1, decoding financial profitability. To make sure everything stays super clear and comparable today, we're going to use one constant set of financial data. We've got our net sales sitting at 600,000, our cost of goods sold at 350,000, and our operating expenses at 150,000, which ultimately leaves us with a net profit of 100,000. Now, on the balance sheet side, we have total assets of 900,000, total equity of 400,000, and 30,000 shares outstanding. Keep these numbers in the back of your mind because they are the key to unlocking all of our ratios. Section 2. Income statement ratios. What makes income statement ratios so great is that they all share the exact same foundation, which is net sales. First up is the operating expense rate. The formula here is incredibly logical. We simply take the operating expenses we want to measure, put them in the numerator, divide by our foundation, net sales, and then multiply by 100. So using our baseline data, that means dividing our $150,000 in operating expenses by the $600,000 in net sales. And that gives us a neat 25%. Basically, a full quarter of all our sales revenue is going straight out the door to pay for operating expenses. Now, why does this actually matter? Well, companies constantly compare this rate to past years. You might think, hey, inflation happens, so expenses are going to go up. True, absolutely. But if your costs are rising due to inflation, you should also be raising your selling prices to compensate, right? Ideally, this 25% rate should stay steady or even decrease over time. If it's creeping up, that is an alarming sign that your expenses are just growing way faster than your revenue. Next, we move to the gross profit rate. Now, you probably noticed we didn't have gross profit listed directly in our initial table, but it's super easy to find. We just subtract our 350,000 cost of goods sold from our 600,000 in net sales, which leaves us with a gross profit of 250,000. We then take that 250,000, divide it by our 600,000 net sales, and multiply by 100. And this brilliantly illustrates exactly how the sales pie is sliced. The result is 41.67%. That means nearly 42% is your raw profit before operating expenses are even touched, while the other 58.33% goes directly into the cost of actually producing the goods. This basically tells us exactly how much markup we have to play with before we start paying for things like rent or salaries or the whole shebang. Finally, we reach the ultimate income statement metric, the net profit rate. This is the final layer of the onion. We place our final 100,000 net profit over our 600,000 net sales and multiply by 100. This gives us 16.67%. And I really cannot emphasize enough just how crucial this number is. This is your final take-home profit margin after literally every single cost and operating expense has been paid. Think about it. If your competitors are boasting a 25% net profit rate and you are sitting at 16.67%, you instantly know your business is lagging behind in efficiency, even if that raw 1 lakh profit sounded pretty great at first. Section 3, return on assets in asset turnover. Let's shift our focus away from the income statement for a second and ask a much more critical question. How hard is our money actually working? That brings us to return on assets, or ROA. Imagine someone asks you to invest 5 lakhs into a business. Your very first question is going to be, well, what is my return? ROA answers this for the entire company. We take our 100,000 net profit and divide it by the massive 900,000 in total assets the company holds. So the crucial point is that our ROA is 11.1%. This means that for every 9 lakhs tied up in assets, machinery, buildings, inventory, the company only generates an 11.1% profit. It's a fantastic way to see exactly how efficiently the company's assets are being utilized to generate bottom-line profit. But we can't stop there. We also need to look at asset turnover. Now, don't confuse this with ROA. Instead of looking at final profit, asset turnover looks at total sales. So we divide the 600,000 in total net sales by the 900,000 in total assets. This gives us an asset turnover of 66.67%.
We use this to clarify how efficiently the company's assets are being used to generate total top-line revenue, completely ignoring expenses for a minute here. It basically tells us that we are utilizing our assets at roughly a 67% efficiency rate just to drive sales through the front door.
Section 4. The owner's equity returns. So we know what the assets and sales are doing, but what is the owner actually getting out of all this? To answer that, we have to make a really vital distinction on our balance sheet. We have $900,000 in total assets, but remember, that includes outside debt. Maybe the company borrowed a bunch of money from a bank. In contrast, the total equity is $400,000. That equity is strictly the owner's actual, pure, out-of-pocket investment in the business. Therefore, we calculate the return on equity, or ROE. We take our same $100,000 net profit, but this time we place it strictly over the $400,000 of owner's equity. We really just want to know how the owner's specific money performed. And the result is a fantastic 25%. Honestly, this is what investors really care about. It means that for every 100 rupees of their very own money invested in this business, the owner is making 25 rupees in profit. The assets as a whole might only be yielding 11.1%, but because of how the business is structured with debt and equity, the owner's personal return is much, much higher. Let's move to and see how this builds into our final metric, book value per share. Step 1 is proving our equity. We combine our share capital of $300,000 and retained earnings of $100,000 to verify our $400,000 total equity. In step 2, we take that $400,000 and divide it by the 30,000 outstanding shares of the company. This calculation gives us exactly 13.33 rupees per share. Why is this so fascinating? Because a share's original par value might just be 10 rupees, and out on the stock market, speculative traders might be buying and selling it for 25 rupees. But the book value cuts through all that market noise. It tells us that if this company were to completely liquidate today, just sell everything and pay off its debts, the owner's true fundamental payout is exactly 13.33 rupees for every single share they own. It shows you the true intrinsic value. Which brings us to our final thought. Now that you understand how to decode these ratios, you can literally see right through the numbers. If a company announces a massive, record-breaking raw profit on the news, but you look at their financials and see their return on equity is actually shrinking, are they really growing? Or are they just borrowing money and expanding their assets to create the illusion of success, while the actual value to the owner just quietly diminishes? It's a question you can only answer once you stop looking at the raw numbers and start calculating the ratios. Thank you for joining me on this explainer, and keep questioning those numbers.